In this video, traders, we're going to look at your quick guide to trading gold. Stay tuned. Hey traders, a very warm welcome to you. So 5-minute guide to trading gold. Let's go. You've got a few options to trade gold. You can buy bullion itself, go out there to a bullion dealer, get delivery of your big chunk of bullion, stash it in your bedroom, under your mattress, in your safe, wherever, or pay them to hold it. That is one way of holding gold. Unfortunately, bullion generally trades at a premium to the spot price of gold, so it's not really an efficient way of speculating on the price of gold. Yes, you could store it, but you've got the insurance to pay for, you've got the premium to pay for. When it comes to actually having the bullion, it's not really the purest way of getting exposure to gold. There's a reason for doing that. That probably isn't what you want to do. The other option you've got is spread betting. You could spread bet or buy a CFD in gold. Very, very simply put, just as you would buy the FTSE Euro US dollar, you go long a pound a point, £10 a point, €10 a point, whatever it may be. Every increment if gold moves up, you're making money. Every increment it goes down, you're losing money. Downside of that, of course, is when you're trading with leverage like that, you're going to have to pay an overnight financing charge. So if you think there's a 3-year view on gold, you may well end up having to pay quite a bit of financing to hold that position. If you've got a short-term view on gold, 1 week, 1 month, whatever it may be, 4 months, you're going to be okay with it. It's not going to cost you an awful amount of money, and you can go short on it, which you can't do obviously if you're buying the bullion. More popular ways, guys, are the futures contracts and ETFs. So let's look at the futures contracts now. This is how the big players and ETFs, but futures is one of the more popular ways that people will speculate on the price of gold. So a futures contract is a contract that expires at a specific point in time. It's the right to buy that product at the specific point in time. So if you're buying at 1,000 on March expiry, it means you've bought one futures contract, which is equal to, or skip over here, 100 troy ounces of gold at 1,000. So when that time comes and the expiry comes, you will take delivery of your gold and you will hand over the money for the value of the gold based on the futures contract price that you paid. No one really wants to take delivery, but yes, you can do it that way. There's lots of costs associated with it. Most people will, if they want to speculate on the price of gold, will buy a futures contract, and then they'll buy a far month dated contract, or they'll buy a near month and they'll roll it over. So as it comes to expiry, they'll close out one and they'll buy the next one. They'll buy the next one, they'll buy the next one. So there's some costs involved with rolling it, but still it's a quite an efficient way of doing it. And again, you're trading on leverage. So let's have a look at futures a little bit more depth. The trade on the CME, so Chicago Mercantile Exchange, the code for them is GC. So futures, you want to put GC, and then you're going to put your month and your year, and your code for your month is going to be a letter. I've done a video on that, or go and Google it if you want to check that out. And some of the charting platforms allow you to put at GC, which gives you a front month of gold. 100 troy ounces in one futures contract. That's the big standardized contract. They do a mini contract or a micro contract, which is 10 troy ounces, so it's a tenth of the size. The standard gold contract trades in a 10-cent increment. So let's say the price of gold is 1,500. It will trade in 10, and the next tick will be 20. The next tick will be 30. So it'll move up like that. So it's got 10 increments before it moves up in a whole dollar. If you buy one contract, you are the price is moving $10 per tick. So one contract, it moves up 10 and you're long, you make $10, you make $10, you make $10, moves up one whole dollar, i.e. 10 ticks, you're going to make $100. And the micro is obviously a tenth of that, so it's going to be $1 for every tick you move, but it's not as liquid, that one. So that's something to look at, guys. The other thing you can do is you can trade an ETF exchange traded fund. GLD is the code for that trade, just like any other stock. You can buy 1 share, 100 shares, a million shares. Tracks the price of gold. It's called the Spiders Gold Trust if you want to search for it, but GLD is the code. And a good thing about the ETF is it allows you to weight it according to your portfolio, because it's just a stock, and because it trades kind of like it's not a stock, but it trades like a stock. You can add it to your portfolio and say, I've got X amount of shares of that. You don't have to subscribe to futures contracts fee, you don't have to have a futures account and try and work it all out. It's just very much similar to trading a normal stock. What moves it? Now this could be a massive video in itself, but let's just quickly go through it. This is a quick guide. Correlation to inflation. Generally it's seen as an inflation hedge, although I would say that now these things might not be as usual as they are. Before, it used to be completely inverse correlated to certain things. Like stock market used to go up, gold used to go down, and vice versa. Not so much anymore. We could go into much detail about why that is, but it doesn't really matter for this video. Supply, generally speaking, listen, when gold is mined, it doesn't go anywhere. Most of the gold that's mined now is still out there somewhere. It's either in a jewelry drawer, it's in a bullion vault or something. So it's not like crude oil when it's used up and then something else have to come in to resupply the demand that's gone, or it's been consumed, it's been eaten. Gold isn't like that, so it's different. There's not very many industrial uses for it. It's really not like copper, where obviously there's a lot of industrial uses for it. There's a small percentage of industrial use. I bet if you had a pie chart, it'd be a very, very small slither. Otherwise, it's just literally a lot of demand comes from in Asia. Indians particularly like gold, Chinese like gold. When that demand picks up and supply is coming in, although generally speaking, as supply comes in, demand follows the price of gold. So it's sort of not really, they're really connected to themselves as opposed to one driving the other. And central banks hold gold. They will sell gold, although there is something called a Washington Agreement, which is really, it's not really a treaty as such. It's a gentleman's agreement that says they're not going to dump more than, I think it's 400 metric tons of gold onto the market any one time. I don't know if anyone's ever broken that, but that is the agreement, because the idea is that everyone's starting dumping gold onto the market. You know what's going to happen, guys. Supply demand comes in, you've got a massive supply, not demand. Price of gold is going to get hammered. So that's really the ways of trading gold. You've got your futures, your ETF, your spread bet. CFD obviously the same as a spread bet, just a different tax wrapper. And what moves it? Just a couple of ideas there. That could be a really complicated whole video in itself, and perhaps hit the subscribe button if you want to, and I'll maybe do a video on that before and do some research and share it with you guys, and we'll see what's moving gold these days if you want to become a gold trader. Other than that, that's gold. Take care, see you in the next one. Bye bye.